One weekend. That's how long it took for a 167-year-old banking giant to effectively stop existing. It's March 2023 in Zurich. Inside closed conference rooms, the most powerful people in Swiss finance are in full panic mode. Regulators, politicians, and rival bankers are pulled into emergency meetings. Phones are buzzing, lawyers are drafting, central bankers are staring at screens. The question on the table is not academic. It's simple and terrifying. Can Credit Suisse survive until Monday? This is not some scrappy fintech app running out of runway. This is Credit Suisse, a bank founded in 1856 to help build the railways and power stations that created modern Switzerland. A bank that survived 2 world wars, the Great Depression, inflation, and every crisis you learned about in school. However, on this weekend, it's reduced to a distressed asset in a fire sale, being shoved into the arms of its old rival UBS like an unwanted suitcase nobody wants to open. The numbers are absurd. Hundreds of billions in assets on the balance sheet. Wealthy clients from New York to Singapore, trading floors across continents. For decades, the name Credit Suisse was basically shorthand for Swiss safety, quiet money, and boring competence. But in a matter of days, that brand flipped from asset to liability. Clients yanked tens of billions in deposits. Counterparties stopped picking up the phone. The market started asking if this thing was the next Lehman. So what really happened here? How do you go from national institution to global punchline in one news cycle? The official explanation talked about loss of confidence and market volatility, which is a polite way of saying people finally stopped believing the story. Because Credit Suisse didn't die from one bad bet or one unlucky crisis. It died from something slower and, in a way, crazier. This is a story of a bank that could handle world wars, but couldn't handle its own executives. For at least a decade, scandal wasn't a bug in the business model. It started to look like the business model. Secret tax schemes for rich clients, traders rigging markets. A bizarre corporate spy saga where the bank literally tailed its own former executives through the streets of Zurich. Each time, there were apologies, fines, new risk controls. Each time, the problem somehow got bigger. As we go deeper down this rabbit hole, things will just get crazier and crazier. You get to Mozambique's tuna bonds, where over $1 billion in loans for a fishing fleet and coastal security quietly morphed into bribes and hidden debt that blew up a country's finances. You get to Greensill, where Credit Suisse happily packaged billions in supply chain finance funds that froze, trapping clients' money. And then Archegos, a family office that managed to blow a roughly $5.5 to $6 billion crater straight through the balance sheet in a single week. By the time that March weekend arrived, the scandals weren't ancient history, they were the recent past. They were the culture. And behind the closed doors in Zurich, everyone knew the uncomfortable truth. Credit Suisse hadn't just been unlucky. It had been playing with matches for years. The only mystery left is how, step by step, a proud Swiss institution turned into a slow-motion crime scene with a banking license. And to answer that, we have to rewind, long before the final weekend. Credit Suisse didn't just trip and fall into a crisis. It spent years building a reputation so warped that one regulator joked it looked like a crime scene with a banking license. That's the level we're talking about here, so this isn't going to be a neat little banking failure explainer about interest rates and risk models. This is a story of how a 167-year-old pillar of Swiss respectability slowly rewired itself around obscene wealth, quiet power, and a business culture where paying fines became just another cost of doing business, like rent or office coffee. On paper, The bank survived world wars, depressions, inflation, everything. However, in the decades before its collapse, it struggled to survive its own executives. Inside, the real balance sheet wasn't assets and liabilities, it was rules and exceptions. Officially, Credit Suisse talked about compliance, ethics, and risk limits. Unofficially, the question was simpler: did this deal bring in enough money to justify the headache? Because once you treat a $1 billion fine as a rounding error, something important breaks. Tax evasion probes, annoying but manageable. FX rigging investigations, bad PR but temporary. The idea that laws were flexible and that rich clients deserved creative solutions stopped being a red flag and started being the product. So what really happened here? Was Credit Suisse just unlucky, hit by a string of freak accidents and a couple of rogue traders who went off the rails? Or was it the logical result of a toxic culture that quietly rewarded rule breaking from the top down? When a trader bends the rules and gets a record bonus, that's not an accident. That's a message. As we go deeper down this rabbit hole, each scandal is going to feel like another episode in the same show. You'll see the tax evasion schemes that helped rich clients hide money offshore, their FX desks that treated currency markets like a private casino, the Mozambique tuna bonds that were supposed to fund fishing boats and ended up funding bribes, kickbacks, and hidden debt instead. And just when you think the problems can't get bigger, along come Greensill and Archegos, wiping out billions in a matter of days. Individually, any one of these could be written off as a one-time mistake. Together, they start to look like a business model. Fines in one column, profits in another, and as long as the second number stayed bigger than the first, the party continued. Things will just get crazier and crazier as the stakes rise and the lessons keep not being learned. But to understand how a cautious Swiss lender turned into a magnet for global scandal, we have to rewind. Back to the 19th century, when Credit Suisse was created to build railways, not risky derivatives. Because the real story starts with conservative DNA and how, decade by decade, that DNA mutated into something far more dangerous. Credit Suisse actually started out as the opposite of a thriller. It was a nation-building project with a balance sheet. In the 1850s, Switzerland was basically a startup country. Newly federal, politically fragile, and physically chopped up by mountains and stubborn little cantons that all had their own rules. You had rich textile towns, new factories, and a lot of ambitious engineers, but not enough railways to tie any of it together. Moving goods across the Alps was slow, expensive, and in winter sometimes just didn't happen. Enter Alfred Escher, lawyer, politician, industrial hype man, before that was a job title. Escher looked at this fragmented landscape and had a very simple, very big idea. If Switzerland wanted to survive between the great powers, it needed steel tracks, tunnels, and bridges, not just cowbells and postcards. But railways were insanely capital intensive, and local savings weren't enough. So what really happened here is that Escher decided to build a money machine for infrastructure. In 1856, he founded Schweizerische Kreditanstalt, the Swiss credit institution. No one was calling it a global investment bank. It was the railway bank. Its core business was raising money from Swiss savers and foreign investors, then funneling that cash into projects like the Nordoostbahn and the Goddard Line. These weren't meme stocks. They were literal mountains being drilled through. From day one, the culture was conservative to the point of boring. Loans were collateral backed. Relationships were local and personal. The bank sat close to the Swiss state, financing public works and working with politicians instead of trying to outsmart them. The big selling point wasn't explosive growth. It was, your money will still be here next year. Inside the bank, that meant gray suits, meticulous files, and a risk appetite that barely qualified as an appetite. Being flashy was a red flag. Being discreet was a business model. Clients didn't want their banker to be a celebrity. They wanted him to be the kind of person you'd trust to water your plants for 10 years and never touch a thing. This is a story of how that railway bank identity became an asset in itself. Swiss households parked their savings there because it felt like putting cash in a vault inside a mountain. Local businesses used it to finance factories and power plants, and foreign investors slowly bought into the idea that Swiss stability was not just a stereotype, but a balance sheet fact. As we go deeper down this rabbit hole, you can see the brand forming. Quiet, safe, slightly dull, and very, very reliable. Over decades, Credit Suisse turned into a kind of financial Switzerland in miniature, neutral, conservative, and allergic to drama, which makes the next part crazy. How does a bank born to stitch a young country together with railways end up arranging tuna fishing loans that secretly buy weapons, blow up an African nation's finances, and nearly sink itself in the process? Stay with this, because things will just get crazier and crazier. Credit Suisse was about to get very un-Swiss. The world changed in the 1980s and 90s, and the quiet business of mortgages and factory loans suddenly looked boring. Deregulation hit. Globalization hit. Wall Street investment banks started making obscene money from trading, junk bonds, leverage buyouts, and exotic derivatives. Goldman Sachs and Morgan Stanley were pulling in fees that made traditional lending look like a charity project. If you were a sober Swiss banker watching this, you had to be thinking, are we the idiots here? So what really happened here is simple on the surface. Credit Suisse decided it didn't want to be the sensible friend anymore. It wanted to be at the party. It built and bought investment banking operations in London and New York, determined to sit at the same table as Goldman, Morgan Stanley, and a rising Deutsche Bank. The idea was straightforward. If the profits are on Wall Street, Credit Suisse needs to be on Wall Street. In London, they bulked up trading desks and M&A teams. In New York, they chased listings, bond deals, and complex securities. The old model of patiently collecting interest on Swiss loans was replaced by a new dream: massive fees today, bonuses tomorrow, and let future you worry about the risk models. This is a story of the star banker era. Suddenly, the heroes of the bank weren't the gray-haired risk officers or the conservative wealth managers. They were the rainmakers, the traders who could swing a few billion in bonds before lunch, the deal-makers who could whisper into a CEO's ear and pull off a multi-billion-dollar merger. These people got paid tens of millions, had their names in the press, and were treated inside the bank like rock stars who just happened to wear suits. However, there was a cost. Power shifted. The cautious Swiss lenders, who thought in decades, found themselves sidelined by aggressive investment bankers who thought in quarters or sometimes in days. Inside the same logo, you now had two completely different cultures strapped together, like an unhappy corporate marriage. On one side, a conservative Swiss wealth management and retail bank, built on discretion, steady fees, and clients who valued not losing money. On the other, a hyper-aggressive investment bank chasing leverage, trading profits, and year-end bonuses. One side was obsessed with prudence. The other side was obsessed with getting rich. Pattern interrupt. If you're thinking, that sounds like every big modern bank, you're not wrong. But at Credit Suisse, the split personality became the whole story. As we go deeper down this rabbit hole, you'll see how the quiet Swiss side kept trying to project stability, while the Wall Street side kept taking bigger swings. The result was constant internal conflict and a growing tolerance for risk. The safer business threw off deposits and respectability. The wild side turned those deposits into bets. What could possibly go wrong when your bonus depends on pushing the limit? Welcome to the spectacular rise and fall of a bank that couldn't decide what it wanted to be. Inside Credit Suisse, that question wasn't hypothetical. It was the business model. Traders, deal makers, and relationship managers lived inside a bonus machine. You booked a big profit in December, you got paid in February. The risk that the trade might blow up in 3 years when markets turned or a client defaulted belonged to some future risk committee and probably some future CEO. Today's gains were real money. Tomorrow's losses were someone else's problem. This is a story of how you turn a 167-year-old Swiss institution into a casino without ever changing the marble in the lobby. Compensation was pegged to short-term revenue, not long-term outcomes. A desk could earn tens of millions by structuring complex derivatives or loading up a top client with leverage. The banker got the cash. The bank got a ticking time bomb buried in its balance sheet. Inside the building, there was a clear hierarchy. At the top were the producers, the people who brought in money. They were the stars, the ones senior management bragged about on earnings calls and at internal town halls. If a producer complained that a risk limit was blocking business, the unspoken assumption was that risk would bend. Compliance existed, but revenue was sacred. Risk managers would raise red flags, write memos, escalate concerns to committees. However, when the person on the other side of the table was a rainmaker who had just delivered a huge quarter, the conversation changed. Suddenly, the question wasn't, is this safe? But how can we make this work? Careers advanced by saying yes, not by being the boring person who said no. On paper, Credit Suisse had layers of protection, models, stress tests, capital committees, risk-weighted assets charts that could fill a small library. In practice, a lot of it started to look like theater. Boxes were ticked, PowerPoints were shown, and as we go deeper down this rabbit hole, things will just get crazier and crazier. The real decision driver was always the same. Would turning this client down mean they walked across the street to a rival bank? Take the way limits were managed for strategic relationships. A hedge fund or family office labeled as a core client could push for higher leverage, looser collateral, faster approvals. If they were generating rich fees, exceptions suddenly became commercially sensible. Someone would sign off on a waiver, maybe temporarily, maybe just this once. Then just this once became standard. That's exactly the setup that made Archegos possible. A highly concentrated, highly leveraged client, treated as a prized relationship, allowed to stack up similar bets across multiple desks and even multiple banks. Each team saw its own revenue. Few people wanted to be the one to say, "This looks crazy." So what really happened here is not just a few bad trades. It's a culture that paid people to ignore bad news and rewarded them for pushing every limit. When you build a system like that, how shocked can you be when the red flags you kept waving away turn into multi-billion-dollar explosions? That culture met the perfect fuel, secrecy. And in Switzerland, secrecy wasn't just a feature of the business, it was the brand. For decades, Credit Suisse sold something incredibly simple to the rich. Put your money here and no one needs to know. Swiss banking laws protected client identities so fiercely that numbered accounts sounded like something out of a spy movie. But for a certain global elite, that was exactly the appeal. If you were a billionaire oligarch, a discreet CEO, or just a dentist from New Jersey who really hated paying taxes, Credit Suisse had a product for you. On paper, it was all about privacy and safety. In practice, the line between discretion and tax evasion got very blurry, very fast, and inside the bank, that blur was treated less like a legal risk and more like a clever business idea. The US tax evasion case ripped that curtain open. For years, Credit Suisse bankers actively helped thousands of American clients hide assets offshore. They flew into the US on tourist visas, met clients in hotel lobbies and coffee shops, handed over statements on USB sticks so nothing would go through the mail, and coached people on how to keep accounts secret from the IRS. This wasn't one rogue employee. This was a system. By 2014, the story caught up with them. Credit Suisse pleaded guilty to criminal charges in the US and agreed to pay about $2.6 billion in fines. A 158-year-old Swiss bank admitting to a felony. For regulators, it was a landmark. For the public, it was a scandal. For a lot of people inside Credit Suisse, it was Tuesday. This is the crazy part. Instead of a deep moral reckoning, many insiders framed it as an expensive parking ticket. Painful, sure, but survivable. The bank raised fresh capital, executives talked about moving forward, and the core lesson that stuck wasn't never again. It was, we can take a hit and keep going. Fines became just another line in the budget. So what really happened here is that rule bending got normalized, not neutered. And the tax case wasn't alone. Credit Suisse turned up in mortgage securities mis-selling investigations after 2008, accused of packaging toxic home loans and offloading them onto investors who didn't understand the risks. It appeared in probes into LIBOR rate, rigging, and foreign exchange manipulation, where traders across multiple banks were caught nudging benchmarks to juice profits. Each case added another entry to a growing compliance rap sheet. This is a story of a bank that kept promising regulators it had learned its lesson, while quietly teaching its own people that aggressive behavior still paid. As we go deeper down this rabbit hole, things will just get crazier and crazier. Because by the mid-2010s, Credit Suisse had crossed a line. It wasn't just the occasional scandal anymore. It was a pattern, structurally baked into how the bank made money. And the next wave of deals would show just how far they were willing to push it. Inside Credit Suisse, the real drama wasn't always on the trading floor. It was a few floors away, in low-ceiling rooms where the carpets were old, the coffee was bad, and the spreadsheets were terrifying. Picture it. Analysts hunched over exposure reports at 10 p.m., scrolling through endless rows of numbers that almost no one outside the building would ever see. Stress tests showing what happened if markets dropped 20%. Dashboards flashing client concentration risk in bright red. This was the part of the business that never made the glossy investor decks, but quietly measured how close the bank was skating to the edge. On paper, these were the people hired to say no. Risk officers flagging complex structured products. They barely understood even after 3 meetings. Questioning why a handful of hedge funds or family offices controlled billions in exposure. Asking why certain strategic clients always seem to get exceptions, waivers, and special terms. In theory, they were guardians. In practice, they were speed bumps. Because on the other side of the hallway sat the revenue machines, star bankers who brought in huge deals, huge fees, and, conveniently, huge bonuses. When risk raised concerns, front office teams would arrive with slide decks, charm, and a very simple argument. If we don't do this trade, our competitors will. You can guess who usually won that debate. This is a story of quiet, grinding pressure. A risk manager who pushed too hard on a lucrative client might see their promotion reconsidered. A team that blocked too many deals suddenly found its budget cut, its headcount frozen, its influence shrinking meeting by meeting. No one sent an email saying, "Ignore the rules," but careers have a way of interpreting silence. So what really happened here was a cultural tax on dissent. People learned to phrase objections as points to monitor instead of absolutely not. Reports were written in softer language. Red flags became amber, amber became yellow, and by the time anything was clearly unacceptable, the money was already booked. After all, who wants to be the person who kills a deal that makes the bank look rich on the next earnings call? Meanwhile, the theater was immaculate. Mandatory online trainings with cheerful animations about integrity. Town halls where executives talked about zero tolerance and world-class compliance. Thick policy documents uploaded to intranet portals that almost no one read. From the outside, it looked strong. Inside, exceptions and waivers flowed through side channels, especially for clients tagged as key relationships. As we go deeper down this rabbit hole, the gap between appearance and reality will get harder to ignore. Because when the Mozambique tuna bonds exploded, when Greensill froze $10 billion of client money, when Archegos blew a $5.5 billion hole in the balance sheet, something awkward kept surfacing in the postmortems. Internal warnings, sometimes years old, sitting in email archives and forgotten risk memos. How many disasters were really unforeseeable, and how many were simply inconvenient to stop? Welcome to the spectacular rise and fall of a bank, where the numbers told one story, but the incentives told another. And in the next scandals, that clash would finally break into public view. Those inconvenient disasters were about to stop being hypothetical. They were about to get very real for one of the poorest countries on earth, early 2010s Mozambique. A low-income coastal nation, rich in potential but short on cash, is sold a grand idea. Transform its fishing industry, patrol thousands of kilometers of coastline, and leap into modernity with more than $1 billion in fresh money. On paper, it sounded almost wholesome. Tuna, jobs, security, growth. Behind the scenes, Credit Suisse bankers saw something else. Fees, deal flow, and a complex structure they could sell to rich investors in London and beyond. This is a story of how a tuna fishing dream quietly morphed into one of the most toxic deals in modern emerging market finance. The pitch was simple enough. Mozambique would borrow heavily to create a national tuna fleet, build onshore processing, and fund maritime security. Credit Suisse and a smaller Russian bank would arrange a series of loans and bonds. These instruments were sliced, packaged, and marketed to international investors as sovereign-backed, development-style projects. Tuna was the friendly label on the box. However, as we go deeper down this rabbit hole, the label starts to peel off. Inside the structure were 3 opaque state-owned companies, barely functioning businesses that suddenly took on enormous debts. Key contracts were awarded to a single Lebanese-based contractor. The documents were dense, the guarantees complex, and crucially, huge chunks of the borrowing were kept off Mozambique's public books. So what really happened here? According to prosecutors in later court filings, a large slice of the money never came close to building a viable fishing industry. Instead, it was allegedly siphoned into bribes and kickbacks for bankers, officials, and middlemen, as well as overpriced or unsuitable military equipment. Think patrol boats and coastal radar that didn't obviously match the tuna marketing deck. Inside Credit Suisse, there were risk memos, compliance questions, and emails flagging problems with the contractor and the structure. But the deals went ahead. Star dealmakers pushed. The bank collected tens of millions in fees, and investors snapped up the paper, reassured by the Credit Suisse name and the sovereign guarantees. On the surface, it looked like clever frontier market business. Underneath, the foundations were already cracking. When the hidden debts finally surfaced in 2016, Mozambique's economy was thrown into crisis. The currency crashed, aid was frozen, and the country effectively defaulted on parts of its debt. Lawsuits exploded across jurisdictions. Investors suing Credit Suisse, Mozambique suing the contractor, regulators circling. Everyone pointed at everyone else. The tuna, somehow, was nowhere to be seen. For Credit Suisse, this was a turning point. This wasn't a tiny technical compliance issue buried in a footnote. It painted the bank as willing to engineer opaque, high-fee deals that helped blow up a poor country's finances. And as regulators dug through the rubble, things would just get crazier and crazier because Mozambique wasn't an outlier. It was a preview of how the bank did business when it thought no one was really watching. Inside the Mozambique deal room, the emails tell a very different story from the glossy pitch decks. On paper, this was about tuna fishing, coastal security, development. In the inboxes of Credit Suisse bankers, it looked a lot more like a money machine with a corruption problem attached. Regulators later dug up internal messages where bankers flagged significant concerns about the contractor, Privinvest, and the sky-high pricing of boats and equipment. One whistleblower claimed people inside the bank knew the contracts were inflated and that politically connected middlemen were circling the deal. So what really happened here if those doubts were already on the record? This is a story of due diligence that technically existed, but functioned more like theater. Compliance teams did their checklists. Risk committees held their meetings. However, when questions came up like, why is this patrol boat multiple times the market price? Or why is this obscure intermediary taking such a big cut? The answers were flexible. As long as the fees were rich and the deal moved, the problems could be managed. You see it in the timelines. Processes that should have taken months were rushed through in weeks. External reports warning about Mozambique's debt capacity and governance were acknowledged, then quietly sidelined. One UK regulator later said Credit Suisse failed to properly manage the risk of bribery and corruption around the whole structure. Translation: the red flags weren't invisible, they were just inconvenient. So, was this really just a couple of rogue bankers gone wild? That's the comforting version. The reality is harsher. Yes, a small group of dealmakers in London and Zurich pushed these loans through, allegedly taking millions in kickbacks from Privinvest, but they operated inside a system that rewarded revenue first, questions later. If your bonus depends on closing the trade, how hard do you really want to look for reasons to kill it? As we go deeper down this rabbit hole, the pattern gets harder to ignore. Senior managers signed off even as internal controls failed. Committees saw partial information. Nobody wanted to be the person who said no to a strategic frontier market client. The bank liked to talk about values and risk culture. The actual culture said, bring in the money and don't make trouble. Eventually, the bill arrived. In 2021, Credit Suisse agreed to pay around $475 million to US, UK, and Swiss regulators, and forgave hundreds of millions more in Mozambican debt. In the US, the bank admitted to defrauding investors about the corruption risk. In the UK, it admitted serious compliance failures. The official line stopped just short of saying, yes, we helped enable a sovereign debt disaster. And yet, after all that, the bank kept going. No license pulled, no existential breakup, just another scandal added to a very long list. If a global institution can help blow a hole in a poor country's finances and still carry on, what message does that send to the next ambitious banker eyeing a messy deal? Because Mozambique wasn't the last time Credit Suisse looked the other way. It was just the moment the mask started to slip, and what came after would make this look almost tame. Mozambique was ugly. But what came next felt less like banking and more like a rejected born script. Because suddenly, Credit Suisse wasn't just arranging shady loans, it was allegedly following people through the streets of Zurich. This is a story of a 167-year-old institution that somehow decided its next big idea was corporate espionage. Not against rival banks, against its own former executives. When a place that's supposed to guard your money starts acting like a discount spy agency, you know the culture has problems. The drama kicks off in 2019 with one man, Iqbal Khan. He was Credit Suisse's golden boy in wealth management, the guy helping reel in the ultra-rich. Then he quit, and in the ultimate Swiss betrayal, crossed the street to arch-rival UBS. That alone hurt. However, what allegedly happened next was insane for a country where people whisper about interest rates like state secrets. Credit Suisse's then COO, Pierre-Olivier Bouet, and others were accused of hiring private investigators to tail Khan, not metaphorically, literally follow him, in cars, through Zurich, with cameras. As we go deeper down this rabbit hole, things will just get crazier and crazier. There were reports of Khan noticing he was being watched, speeding up his car, trying to shake the tail. One day, he confronted the investigators on a quiet Zurich street, in front of his wife and kids. Imagine thinking you're in wealth management and suddenly realizing you're in a low-budget spy thriller. This wasn't Wall Street, it was Surveillance Street. The Swiss public was stunned. This is a country where banks are supposed to be boring, discreet, almost invisible. Instead, they got car chases and stakeouts. Then the story turned dark. A contractor linked to the operation died by suicide shortly after the scandal broke, adding a tragic human cost to what had started as petty corporate paranoia. Internal investigations followed. Reports blamed rogue decisions, compliance failures, and bad judgment. Bouet resigned, but the real shock came when CEO Tidjane Thiam, who denied knowing about the spying, was pushed out too. Officially, it was about trust and leadership. Unofficially, the message was clear. This had made Credit Suisse look ridiculous on the world stage. So what really happened here? On paper, it was one surveillance operation targeting one ex-executive. In reality, it exposed a leadership team so consumed by status games and internal feuds that they treated a banker switching jobs like a national security threat. And that's the metaphor that matters. When the people running your bank don't trust each other, why should clients trust them with billions? When the C-suite is busy tracking ex-colleagues through Zurich, who's actually watching the risk books? Welcome to the spectacular rise and fall of a bank that forgot it was a fiduciary and started acting like a spy ring. Because if this was how they handled office politics, wait until you see how they handled actual financial risk. That spy ring mentality wasn't a glitch in an otherwise healthy system. It was a symptom of something deeper. Nobody was actually in charge of the culture. Credit Suisse in the 2010s basically ran a leadership speed dating service. You had Brady Dugan, the American trader who'd ridden the pre-2008 boom, and was suddenly talking about a safer, client-focused bank. Then came Tidjane Thiam in 2015, the suave insurance executive promising a new Credit Suisse after the tax evasion and FX scandals. And when his era blew up in corporate espionage and losses, in walked Thomas Gottstein, selling yet another fresh start. Every new CEO arrived with the same script: big town hall, somber apology, a line about learning from the past and turning the page. This is a story of a 167-year-old institution that kept trying to reinvent itself every 3 years without ever fixing the operating system underneath. Strategic priorities whipsawed with each personality. One year, the big idea was clear: shrink the volatile investment bank, double down on boring, rich client wealth management, be the safe Swiss steward of money again. The next year, when markets were hot and trading profits looked crazy good on PowerPoints, the message quietly shifted. Maybe we don't shrink quite so much, maybe we optimize, maybe that leveraged finance desk isn't so dangerous after all. So risk appetite went on a roller coaster. Risk limits were tightened after one scandal, loosened when dealmakers complained about losing business, rewritten again when a new team wanted to re-energize growth. If you were a managing director on the floor, which version of Credit Suisse were you supposed to believe? That instability made accountability incredibly easy to dodge. Problems were always legacy problems. Mozambique tuna bonds? That was the last guy's strategy. Tax evasion? Old regime? FX rigging? Pre-crisis culture. By the time internal reports landed, the people who'd signed off on the risk were already golfing with their retention bonuses. As we go deeper down this rabbit hole, you start to see how convenient, constant transformation can be when no one wants to own the mess. Publicly, the messaging was zero tolerance, tough memos, video messages about integrity, town halls where executives said, with very serious faces, that any misconduct would be dealt with. However, inside the bank, big producers who bent the rules but generated fees were often coached, reassigned, or quietly protected. Fire the small-time rule breaker, keep the rainmaker. What kind of culture does that actually teach? Employees got the hint. The real rule was don't embarrass the firm in headlines and keep the revenue flowing. Everything else was negotiable. So what really happened here when risk managers tried to say no to a star client or a profitable structure? They were told to be commercial, to find solutions, to enable the business. Culture lost the argument to money almost every time. Things will just get crazier and crazier when that kind of leadership carousel finally meets real-world stress. And in 2021, two names, Greensill and Archegos, were about to smash straight into this wobbling structure and expose just how fragile it really was. Greensill was where safe finally stopped meaning anything. On paper, this was the boring end of finance. No wild derivatives, no crypto, just invoices. Greensill Capital's big idea was supply chain finance. They'd pay a company's suppliers early, then collect later from the company, packaging those short-term IOUs into neat investment products. Short duration, diversified, supposedly backed by real business flows. It sounded almost like cash with a slightly better yield. And Credit Suisse loved that pitch. For a bank that sold itself as the gold standard of Swiss wealth management, this was perfect marketing. Around 2017, Credit Suisse built a suite of Greensill-linked supply chain funds, eventually reaching about $10 billion. Relationship managers told rich clients they were buying ultra-conservative, well-diversified cash management tools. Not hedge fund roulette, not equity market drama, just low-risk, short-term paper that quietly earned a bit more than a savings account. So what really happened here? Behind the glossy pitch decks, the diversified part started to look a lot less convincing. Large chunks of the money were effectively tied to a small group of borrowers, some of them far from blue chip. There were exposures to companies that were already controversial, credits backed by future receivables that didn't clearly exist yet, and complex insurance arrangements that most clients had never heard of, let alone understood. Inside Credit Suisse, risk people and some investment pros began asking awkward questions. How was Greensill finding so many supposedly safe assets with such attractive yields in a world starved for income? Why did so much depend on one charismatic founder and a few key insurers? Outside analysts and journalists also started circling, pointing out that Greensill's business seemed to grow faster than the boring reality of corporate invoices should really allow. However, the money kept flowing. The funds were profitable, clients were happy, and in a culture where enable the business beat be the wet blanket, doubts didn't exactly win popularity contests. It's hard to be the person who tells a billionaire their cash product is actually a layered credit bet on a niche finance company. Then, in early 2021, the music stopped. Greensill's key insurance backstops were pulled, regulators moved in, and the firm hurtled toward insolvency. Suddenly, those safe, daily liquid Credit Suisse funds didn't look so liquid. In March 2021, Credit Suisse froze roughly $10 billion of Greensill-linked funds, trapping client money while it scrambled to recover whatever value it could. For some of the bank's most valuable customers, this was a gut punch. They hadn't signed up for venture-style risk. They thought they were parking conservative savings with a 167-year-old institution that practically printed the word trust on its letterhead. Now, their cash was stuck in a collapsing supply chain finance empire they'd barely heard of. This is a story of reputational damage that hit where Credit Suisse was supposed to be strongest: stewardship of client wealth. The immediate question wasn't how much the bank itself would lose, but whether it still deserved its wealth management crown. As we go deeper down this rabbit hole, another scandal was already brewing next door, ready to show that Greensill wasn't a one-off accident, but part of a pattern. And things would just get crazier and crazier with Archigos. Inside Credit Suisse, the Greensill deal room looked like everything was working perfectly. The funds were smooth, the charts went up and to the right, and the money kept pouring in. However, behind those glass walls, the people paid to worry were starting to panic. Risk teams began flagging the same crazy pattern. Greensill's diversified supply chain finance wasn't really diversified at all. Huge chunks of the portfolio were tied to just a few borrowers like Sanjeev Gupta's GFG Alliance, often through opaque structures that made it hard to tell who actually owed what. On top of that, the whole thing leaned heavily on a stack of insurance policies that looked fine in a slide deck, but might melt the second anything went wrong. External analysts were asking similar questions. How could this business idea be so safe if returns were so consistently rich in a zero-rate world? Why was so much exposure wrapped around future invoices that sometimes didn't even exist yet? The answer, again and again, was some version of, "Don't worry, it's insured." But insurance only works if the insurers actually pay, and if the contracts survive lawyers' stress and panic. That was a very big if. Inside Credit Suisse Asset Management, the incentives were pulling in the opposite direction. These Greensill-linked funds were a gold mine, billions in client assets, juicy management and performance fees, and a product that private bankers could pitch to wealthy clients desperate for yield without taking equity risk. On paper, it sounded perfect. Low volatility, steady income, and the halo of a Swiss brand. In practice, it was a machine that everyone was scared to turn off. So what really happened here? This is a story of memos versus meetings. Risk officers wrote detailed notes about concentration, about reliance on a single insurer, about the danger that if that insurer walked away, the whole structure could implode. Committees met, PowerPoints were shown, hedges and tweaks were proposed. But each time, the final decision tilted the same way: keep the product, keep the clients, keep the fees. Nobody sent an email saying, "Ignore risk, we like the money." They didn't have to. The message was in bitter what got escalated, what got delayed, and what got quietly waived. When Greensill pushed for exceptions, Credit Suisse granted them. When documentation was incomplete, someone signed a waiver. When limits were breached, they got temporarily adjusted. The bank could talk for hours about risk management. In practice, risk management was something you worked around. After Greensill collapsed and the funds were frozen, the postmortem was brutal. Lawsuits accused Credit Suisse of failing its fiduciary duty, of not properly assessing or disclosing the real risks, hiding under those smooth return lines. Regulators asked why clients were never told just how concentrated the exposure was, or how fragile the insurance backbone had become. As we go deeper down this rabbit hole, Greensill starts to look less like a freak accident and more like a dress rehearsal. Credit Suisse had proven it could sideline its own risk controls when the business was too profitable to question. The only problem was another client was about to test that exact weakness on an even bigger scale. And compared to what was coming with Archegos, Greensill would look almost boring. Compared to what was coming with Archegos, Greensill would look almost boring, because the next blow didn't come from a sovereign state, a giant corporation, or some complex global program. It came from what was, on paper, just one rich guy's family office. Meet Archegos Capital Management. No flashy brand, no trading floor packed with shouting 20-somethings. Just Bill Huang running money for himself after his hedge fund days ended badly. He'd already been banned from trading in Hong Kong for insider trading, which you'd think might be a clue. However, in the strange world of modern finance, that made him a high-conviction client rather than a radioactive one. Archegos wasn't a normal fund. As a family office, it didn't have to disclose positions the way a big hedge fund would, so Huang quietly built huge concentrated bets in a small handful of media and tech stocks like Viacom CBS and Discovery, not by just buying shares, but by using total return swaps, derivative contracts where the bank technically owns the stock, but Archegos gets the economic exposure. On paper, that sounds neat and tidy. In practice, it meant multiple banks were each lending Archegos insane amounts of money to make the same trades, while none of them could fully see the total risk. Credit Suisse, Nomura, Morgan Stanley, UBS, others. Everyone thought they had a great sticky client paying juicy fees. No one realized they were all standing on the same rickety platform. This is a story of leverage disguised as sophistication. Archegos might put up, say, $1 billion, and through swaps and margin, control many billions more in exposure. The business idea was simple. If the stocks kept going up, everyone made money and looked smart. If they fell, there was supposed to be collateral, risk limits, margin calls. Supposed to be. Then came March 2021. Viacom CBS and other Archegos names started dropping after a big share sale spooked the market. Prices fell, risk systems lit up, and the bank started calling Huang for more collateral. He didn't have it, or at least, not nearly enough. So what really happened here when Archegos couldn't pay? The banks had to start dumping the stock they held as collateral, all at once, into a falling market. It turned into a fire sale. The faster they sold, the more prices crashed, and the more everyone else's positions blew up. Things will just get crazier and crazier when every exit is a narrow door and all the elephants run for it at the same time. Some banks moved fast and cut their exposure. Credit Suisse did not. When the dust settled, Credit Suisse alone lost around $5.5 to $6 billion from this single client, one quiet family office, one cluster of media stocks, one risk department that either couldn't or wouldn't say no. As we go deeper down this rabbit hole, Archegos becomes the perfect pattern interrupt. A supposedly diversified, sophisticated global bank nearly crippled because it let one over-leveraged client turn risk management into a suggestion. And the crazy part, inside Credit Suisse, this wouldn't even be the only time that pattern showed up. So how do you lose roughly $6 billion on a single client and still call yourself a sophisticated global bank? At Credit Suisse, that wasn't a plot twist. That was just Tuesday. To understand Archegos, you have to understand the quiet little monster behind it: total return swaps. On paper, they sound boring. In reality, they're like giving someone the keys to a sports car, letting them floor it, and agreeing that if they crash, you'll pay for the damage. Archegos would pick a stock, say Viacom CBS, and a bank like Credit Suisse would buy the actual shares. Then, through a swap, Archegos got all the upside or downside as if it owned the stock, without ever putting its name on the shareholder register. So what really happened here is that Archegos could build massive synthetic positions in the same companies at multiple banks, all in the shadows. No public disclosure, no 13F filing screaming, "This guy is insanely long media stocks." Just a family office quietly piling on leverage. The banks fronted the money, took the shares as collateral, and told themselves they were being clever. Archegos looked rich. The risk sat on Credit Suisse's balance sheet. Inside the bank, there were supposed to be limits, hard caps on how much exposure you could take to a single client, how much you'd lend against volatile stocks, how concentrated one book could get. However, Archegos was labeled a top client. That magic phrase turned rules into suggestions. Internal reports later showed exposure limits being raised, waived, or simply ignored as the positions grew. When risk managers flagged problems, front office relationship bankers pushed back. Archegos brought in fees. Fees were king. This is a story of risk teams that were outgunned and outnumbered. Reviews after the blowup found under-resourced risk departments, outdated systems that couldn't aggregate exposures across desks in real time, and a culture where saying no to a big client was a career risk. Some staff literally tracked Archegos exposure in spreadsheets while the positions were exploding. It's hard to fight crazy leverage with Excel. Other banks saw the smoke. When Archegos started getting margin calls, several prime brokers moved fast. They dumped collateral, sold the stocks, and cut exposure within hours. It was brutal, but it was survival. Credit Suisse, however, hesitated. There were internal debates, hopes the client would find new money, worries about upsetting the relationship. While rivals were racing for the exits, Credit Suisse was still politely looking for the door handle. By the time they moved, the market had already been flooded with stock. Prices collapsed. The collateral wasn't enough. Credit Suisse was left holding the bag, and that bag had a multi-billion-dollar hole in it. As we go deeper down this rabbit hole, Archegos stops looking like a one-off bad trade and starts to feel like a neon sign. The risk culture, the governance, the whole idea of who actually controlled the business had broken. And the crazy part? The next scandal would prove this wasn't even rock bottom. Within weeks, the wheels came off. Not one scandal, but two, slamming into Credit Suisse like a double punch the bank never really recovered from. First hit, Greensill. In early March 2021, Credit Suisse suddenly froze about $10 billion of supply chain finance funds that had been sold as safe, almost boring cash-like products, quietly stuffed with exposure to Lex Greensill's fragile business empire. Clients had been told this was a smart way to park money. Overnight, they learned their cash was locked and maybe not coming back in full. Before anyone could even process that, the second punch landed. Late March 2021, Archegos blew up. Credit Suisse announced a loss that would end up around $5.5 billion from a single highly leveraged family office. The same bank that had just embarrassed itself with Greensill now had to admit it had been handing out prime brokerage credit like party favors to a client who wasn't even a hedge fund. This is a story of a narrative shattering in real time. For years, management had been selling a comforting idea. Credit Suisse was de-risking, moving away from Wild West trading, focusing on steady wealth management and tightening controls after each scandal. Every new CEO arrived with a transformation plan. Every investor day promised less drama and more stable fees. However, the Greensill and Archegos 1-2 combo made that story look crazy. If this was a safer bank, why were billions of client funds tied to a shaky supply chain financier? If controls were tighter, how did risk managers sign off on Archegos piling up massive swap positions across multiple banks, with Credit Suisse apparently the least skeptical adult in the room? Markets didn't buy the spin. The share price plunged as the Archegos loss came into focus, wiping out years of slow recovery. Credit default swap spreads on Credit Suisse debt widened sharply, a dry technical way of saying investors now wanted a lot more money to insure against this bank blowing up. Analysts on earnings calls started asking the really basic, humiliating questions. Were risk controls actually fit for purpose? Who exactly was in charge here? Inside the bank, it felt less like a transformation and more like a purge. Senior executives were pushed out, risk heads rotated, committees reshuffled. Bonuses were clawed back from top managers, which played well in headlines but didn't fix the core problems. Staff who had already survived tax cases, FX rigging, Mozambique tuna bonds, and espionage scandals were told, again, that this time the culture would really change. Crisis fatigue set in, talented people quietly left. The ones who stayed joked, a bit too bitterly, that Credit Suisse was becoming a case study instead of a career. As we go deeper down this rabbit hole, you start to see why. On paper, 2021 should have been the wake-up call. So what really happened here? If Greensill and Archegos cracked the facade this badly, why did the true death spiral only kick off 2 years later, in 2023, when the bank suddenly ran out of trust? The crazy part is, Credit Suisse was never flying under the radar. It was one of the most watched banks on earth. You had Swiss watchdog FINMA on one side, European regulators on another, US authorities digging into the Wall Street business, and a whole chorus of rating agencies giving their official stamp. Everyone had a piece of the elephant. No one seemed to notice the elephant was drunk, on fire, and juggling chainsaws. On paper, this was the definition of safety. Credit Suisse was labeled a systemically important financial institution, a global SIFI. That label means extra capital rules, extra stress tests, extra meetings where people stare at risk dashboards and nod gravely. Rating agencies kept it in investment-grade territory for years. The message to clients and investors was simple. This might be messy, but it's not going to die. However, as we go deeper down this rabbit hole, you start to see the illusion. Fines and enforcement actions piled up. US tax evasion, mortgage securities, Mozambique tuna bonds, Greensill, Archegos. Each time, a regulator would swoop in, issue a report, extract money, demand a few promises. The bank would say it was turning the page. Then it would just start writing the same story again on the next one. This is a story of being almost too regulated to fail. Not too big to fail. Too regulated. There were so many rules, frameworks, and checklists that everyone could point to their own box and say, look, we did our job. Risk committees met. Compliance ran trainings. FINMA opened investigations. The ECB watched European entities. The Fed and the SEC watched US operations. Rating agencies watched capital ratios. But who was watching the culture? Who was asking why the same kinds of problems kept coming back with different brand names? Critics later said the oversight was mostly reactive. Regulators were great at showing up after the explosion, sweeping up the debris, and handing out tickets for the mess. They were much weaker at forcing deep structural surgery on the business model. Capital surcharges went up, but the hunger for fee income stayed. Individuals were banned or fined, but the incentive systems that made cutting corners profitable often survived with a fresh coat of paint. The irony is that the steady drumbeat of medium-sized fines almost became part of the background music. A few $100 million here, a couple of billion there. Markets shrugged. Rating agencies said the bank still had plenty of capital. Swiss officials stressed that Credit Suisse was important, but also sound. The signal people heard was not danger, it was, "This is under control." So what really happened here is that punishment became proof of safety. If regulators kept hitting the bank and it was still standing, surely that meant it was strong enough to keep going, right up until it wasn't. And when the real run finally started, all those labels and ratings did something strange. They made the shock even worse. Because if the safe bank could implode over a single weekend, what did that say about the entire system built to watch it? That line about the whole system being broken landed hard. But for Credit Suisse, critics were already using an even sharper one. They called it a financial crime scene with a banking license. Not a troubled bank, not a risky bank, a crime scene. That's how far the brand had fallen, and it wasn't just internet snark. You had serious commentators and ex-bankers repeating it on TV like it was an official job title. This is a story of how a 167-year-old institution slowly became a punchline. At first, each scandal was treated as a one-off. A little tax evasion here, some FX rigging there, bad sure, but every big bank had paid those fines. The narrative was still, a few bad apples, lessons learned, moving on. However, as we go deeper down this rabbit hole, the pattern gets harder to ignore. Mozambique's hidden tuna bonds blow up, revealing over $1 billion in secret debt and bribes. Then Greensill implodes, freezing $10 billion of client money. Then Archegos detonates, wiping out another $5 or $6 billion in a weekend. And suddenly, the media stops writing about incidents and starts writing about culture. Articles shift from Credit Suisse loses money on X to inside the bank that keeps finding new ways to blow itself up. Reporters connect the dots. The same aggressive dealmakers, the same sidelined risk teams, the same executives promising that this time the problems are fixed. Things will just get crazier and crazier, because once you frame a bank as a repeat offender, every new headline feels like confirmation. Inside the bank, that line about a financial crime scene wasn't funny, it was personal. Employees talked about avoiding the company name at parties or saying they worked in finance and hoping no one asked to follow up. Private bankers would sit down with rich clients expecting to talk markets and instead get, "So what's the latest scandal?" That's not a great opening question when your entire business is built on trust. And here's the quiet part people miss. Reputational damage in banking is a slow leak, not a sudden explosion. Clients don't usually yank all their money after the first bad headline. They roll their eyes after the second. They start moving a slice of assets after the third. But there's always a tipping point where nervous becomes gone. So what really happened here is less about one balance sheet shock and more about a binary switch. Either people believe their bank is basically honest and competent, or they don't. Once enough clients start to feel like they're banking with a crime scene, it almost doesn't matter what the capital ratio says. And that's the pattern interrupt in this story. Welcome to the spectacular rise and fall of a bank that didn't just run out of money, it ran out of trust. The next part is what happens when that trust finally snaps. And when trust snaps at a bank, it doesn't usually start with people lining up outside the branch. It starts with the rich quietly moving their money at 2 a.m. After Greensill and Archegos, that's exactly what began to happen at Credit Suisse. There was no dramatic announcement, no, "I'm closing my account in protest." Instead, private bankers in Singapore would get a polite call. A family office wanted to diversify custodians. A pension fund in the Middle East wanted to reduce exposure. The account technically stayed. The assets did not. On paper, this looked harmless. A billionaire who kept a checking account and a prestige metal card at Credit Suisse might still show up as a client. However, the serious money, the portfolios, the trust structures, the hedge fund allocations would be quietly rebooked to UBS, JP Morgan, or a local champion. This is a story of how a bank can look stable in the brochures while bleeding out behind the scenes. For a wealth management-driven bank, assets under management are oxygen. That's the fee stream, the lending pipeline, the cross-selling machine for mortgages, IPO mandates, and structured products that only a lawyer could love. When AUM walks out the door, you don't just lose management fees. You lose the chance to pitch the next deal, the next loan, the next exclusive fund that makes everyone at the bank a little bit richer. Inside Credit Suisse, people could see the oxygen levels dropping. Internal reports flagged outflows from Asia ex-Japan, from certain European ultra-high net worth desks, from hedge fund clients spooked by Archegos. But in town halls and earnings calls, executives reached for softer language. Outflows were portfolio rebalancing. They were clients taking profits after strong markets. Apparently, thousands of rich people across 3 continents all had the same idea at the same time. The dry joke inside some teams was that trust was not material to the financial statements. But everyone who actually talked to clients knew the real problem. The Greensill and Archegos hits hadn't just cost money. They had shattered the illusion of competence. If the bank couldn't monitor a single family office or a handful of supply chain funds, what else was lurking in the book? That's where the psychology kicks in. Once clients even start to wonder, could this be the next Lehman? The game changes. You don't wait for the regulator's press release. You move first. Even a vague rumor, a scary headline, a bearish analyst note, a WhatsApp message from another banker becomes a reason to preemptively shift 10%, then 20%, then 50% of your assets somewhere safer. As we go deeper down this rabbit hole, those early drips of outflows start to look like the trailer for the real movie. By late 2022, the numbers would stop being manageable and start being existential. And when panic finally arrived in March 2023, things will just get crazier and crazier. So how do you calm a bank run that's still in slow motion? In Credit Suisse's case, you stand up, smile for the cameras, and announce a transformation plan. Again, and again, and again. After Greensill and Archegos in 2021, management finally admitted, at least on paper, that the business model had to change. The new idea sounded simple enough. Cut risk, weighted assets. Shrink the Wild West bits of investment banking. Double down on the rich, stable world of Swiss and global wealth management, and shove the ugliest leftovers into a non-core bad bank. On slides, this is a beautiful story. In reality, you're trying to put a 167-year-old supertanker into reverse while it's already taking on water. The playbook looked familiar. First, promised to slash tens of billions of risk-weighted assets, especially in leveraged finance and securitized products. Then tell investors the glamorous, bonus-heavy trading desks would be capital disciplined and right-sized. Finally, sell the dream that the future Credit Suisse would be a boring, fee-earning wealth machine for rich families from Zurich to Dubai. It was banking as image rehab, the same logo, but now with less chaos. However, transformation plans are expensive, and Credit Suisse didn't have the money lying around. So they went back to the market. In late 2022, the bank raised fresh capital, including from Middle Eastern backers like the Saudi National Bank and Qatar's sovereign wealth funds. The message was clear: look, serious money from the Gulf still believes in us. If they're in, how bad can it really be? For a few days, it actually worked. Each new plan, each capital raise gave the stock a little sugar high. The share price would pop. Analysts would dutifully repeat the words turnaround and inflection point, and executives would do victory laps on earnings calls. But then another legacy problem would crawl out of the basement. Litigation here, compliance failures there, more client outflows in the footnotes. So what really happened here is that every rally turned into a dead cat bounce. There was a deeper issue no slide could fix. This is a story of a bank built around silos, star bankers, and internal turf wars trying to become a tidy, risk-aware wealth manager. While the whole world watched, you had traders who still thought in terms of quarterly P&L sprints, sitting next to private bankers selling stability to nervous millionaires. Changing that culture under constant headlines and regulatory pressure is like trying to rewire a plane while it's mid-flight and trending on Twitter. As we go deeper down this rabbit hole, you can see the structural trap. Every restructuring created more disruption, which spooked clients, which forced more restructuring. Management kept saying the turnaround was on track, but the track itself was crumbling. And then, in March 2023, after all the capital raises and all the plans, one Saudi investor would answer a simple question on TV and help light the fuse on Credit Suisse's final crisis. That one TV answer hit a raw nerve because it tapped into a much older ghost, the ghost of 2008. Back then, one name triggered global panic: Lehman Brothers, a 158-year-old Wall Street institution, huge investment bank, tons of clever products, and then, in a matter of days, gone. Trillions in value vaporize, money markets freezing, governments scrambling. People watched that play out and quietly filed away a fear. If it happened once, it can happen again. Credit Suisse looked uncomfortably familiar. Another century-plus global investment bank. Another balance sheet stuffed with complex trades, derivatives, and cross-border deals. Another business where confidence was oxygen. However, this time, the stage was supposed to be different. After 2008, regulators promised never again. So what really happened here? After Lehman, the rulebook changed. Banks were forced to carry more capital, meaning a bigger cushion of equity to absorb losses. They had to hold liquidity buffers, piles of safe assets they could sell quickly to meet withdrawals. Stress tests, living wills, resolution plans, an entire alphabet soup built around one idea. You shouldn't be able to wake up on Monday with a healthy bank and go to bed on Sunday with a smoking crater. On paper, Credit Suisse ticked those boxes. Capital ratios met regulatory minimums. Liquidity coverage looked fine in official reports. This was the irony. In the sanitized world of spreadsheets, Credit Suisse didn't look like a 2008 rerun. But markets don't live inside spreadsheets. They live inside people's heads. As we go deeper down this rabbit hole, the key difference between 2008 and 2023 is not just regulation, it's psychology. Lehman failed in a world where banks were undercapitalized and liquidity rules were weak. Credit Suisse failed in a world where regulators could pull up a slide deck and say, technically, this bank is solvent. Technically. However, solvency is a slow accountant's concept. Confidence is a fast human one. A bank can be solvent at breakfast and dead by dinner if clients, investors, and trading counterparties decide they don't believe the numbers. Who wants to be the last rich client leaving their money in a bank everybody else is running away from? That's why, in early 2023, every negative Credit Suisse headline triggered the same reflexive question: is this another Lehman? Credit default swaps spiked, social media amplified every rumor, and CNBC Chirons did the rest. The safeguards were real, but so were the memories. Once the phrase systemic risk starts trending, logic moves to the back seat. This is a story of a bank that didn't die because one ratio slipped under a line on a regulator's slide. It died because, after years of scandals and broken promises, belief in those ratios evaporated. The numbers said capitalized. The market said we don't buy it. And in banking, that argument only ends one way. And when a bank this entangled with the global system starts to wobble on pure confidence, things will just get crazier and crazier in the next act. Confidence had become radioactive. And the spark that finally set it off wasn't a balance sheet, or a leaked memo, or some secret dossier of crazy derivatives. It was a TV interview, one question, 3 words. In March 2023, the chairman of Saudi National Bank sat down with Bloomberg. His bank was Credit Suisse's largest shareholder after a big capital raise the year before. So the anchor asked the obvious question: would they put in more money if Credit Suisse needed it? He didn't hedge, he didn't spin, he just said, absolutely not. On paper, it was a boringly logical answer. Saudi National Bank already owned close to 10%. Going higher would trigger extra regulatory problems. Their investment idea was diversification, not turning into a rescue vehicle for a Swiss giant. In any normal year, that's the kind of dry, technical reply that would live and die inside a financial transcript no one reads. However, this was not a normal year, and this was not a normal bank. This was a business already soaked in scandal headlines, trading at a fraction of its former value, with clients whispering about whether to move their cash. So what really happened here is that the market didn't hear regulatory cap. It heard, we're not putting another dollar into this thing. There's the rational story, and then there's the story people actually trade on. Traders clipped the absolutely not soundbite and blasted it across terminals. Social media ripped it out of context, slapped on captions like "Major shareholder refuses to save Credit Suisse." And by lunchtime, the narrative had shifted from troubled bank to dead bank walking. Credit Suisse shares went into free fall. Double-digit intraday plunge. Credit default swaps, the insurance you buy when you think a bank might blow up, spiked to levels that basically screamed, "This is not fine." Clients saw the charts, then their friends' posts, then the headlines, and started asking the one question that kills a bank faster than any scandal. Is my money safe? Here's the pattern interrupt. After years of complex schemes, offshore structures, and billion-dollar problems with names like Archegos and Greensill, one of the most damaging blows came from a simple, unscripted sentence. No exotic product, no secret deal, just a chairman, a camera, and a moment of honesty that landed like a confession. This is a story of how fragile the whole thing had become. When confidence is healthy, a comment like that is a footnote. When confidence is dying, it's a funeral bell. As we go deeper down this rabbit hole, you'll see that by March 2023, people weren't really analyzing Credit Suisse anymore. They were looking for an excuse to run. And a stray absolutely not was all the excuse the world needed to start asking. In unison, is Credit Suisse next? The answer to that question would arrive in a single chaotic weekend. The answer didn't arrive as a press release. It arrived as money quietly vanishing. Not from tourists with checking accounts, but from the people who actually matter to a Swiss private bank. Rich families, hedge funds, corporate treasurers who can move $1 billion the way most of us move a paycheck. Right after the Saudi comment and the fresh headlines dredging up Greensill, Archegos, and every old scandal, those clients started doing the one thing a fragile bank cannot survive. They stopped giving Credit Suisse the benefit of the doubt. In wealth management, relationship managers were suddenly fielding panicked calls. Is my cash safe? Should we split it across banks? Corporate finance teams weren't dramatic, they were clinical. They trimmed credit lines, pulled deposits, and shifted excess cash to JP Morgan, UBS, anywhere that didn't have crisis in the headline that morning. This is a story of a slow-motion stampede. At first, the numbers looked manageable, a few billion here, a few billion there. However, when you've already seen over 100 billion francs walk out the door in late 2022, every extra outflow hits like a punch. To plug the gap, Credit Suisse started tapping its central bank liquidity lines and selling liquid assets. Perfectly rational on paper, but markets don't read balance sheets like textbooks. They read them like gossip. The feedback loop kicked in. The more assets the bank sold to raise cash, the worse the market assumed things were. Bond spreads widened. The share price slipped, then slid, then fell off a small cliff. Each move down wasn't just a market chart, it was a screenshot. And those screenshots were flying around. This wasn't 19th century Zurich, with lines forming outside marble branches. There were no TV images of crowds banging on locked doors. The run was happening in WhatsApp chats and signal groups. Private bankers in Geneva would reassure a billionaire over lunch, and that billionaire's family office would still forward a CDS chart to 3 other banks asking, "Any reason we shouldn't move everything today?" Things will just get crazier and crazier when your risk profile becomes a meme. Social media turned market plumbing into content. A red candlestick on the Credit Suisse stock chart, a spike in credit default swaps, a rumor about collateral calls, all repackaged into viral slideshows for anxious CFOs and rich clients. The irony was brutal. Years earlier, the bank had paid fines for helping people hide money. Now it was watching money disappear in plain sight, one tap at a time. As we go deeper down this rabbit hole, you can see the core problem. A digital bank run is almost invisible until it's already huge. Billions can leave before regulators even finish their morning coffee. By mid-March, the question inside Credit Suisse wasn't, how do we fix this, but who's going to catch us when we fall? The bank was no longer in control of its own fate. The only real suspense left was how it would be saved, and by whom. By Friday night, the question had an answer. Credit Suisse would be caught in Zurich. The only problem was that nobody in the room agreed on how. Inside the marble and glass world of Swiss officialdom, regulators, government ministers, and the top brass from UBS and Credit Suisse were hauled in for what would become a marathon crisis weekend. Phones were buzzing with calls from London, New York, Frankfurt. Markets were closed, but the fear was simple. If they didn't have a solution by Sunday, Monday could be chaos. This wasn't just about one bank having a bad week. Credit Suisse still carried hundreds of billions in assets, a sprawling derivatives book, and tentacles in every major market. Letting it fail outright wasn't some tidy bankruptcy story. It was a potential contagion event. Trading counterparties could freeze, money markets could panic, and every other wobbly European bank would suddenly look radioactive. So what really happened here in these closed-door meetings? On paper, they had options. One was full nationalization. The Swiss state would take over Credit Suisse, guarantee everything, and hope taxpayers didn't notice the bill until later. However, that ran into instant political problems. Switzerland prides itself on being conservative with money. Turning a world-class private bank into a state-owned problem was not exactly an election-winning idea. Another idea was a breakup, carve out the healthy Swiss domestic bank, ring-fence the toxic investment bank, and slowly wind it down. But time was the enemy. You can't surgically separate a global balance sheet in 36 hours. Every lawyer in the building could see the liability nightmare coming. That left the ugliest, most realistic option, a forced marriage with UBS, Credit Suisse's longtime rival. Think shotgun wedding, but with term sheets. UBS executives walked in very aware of their leverage. They didn't want the business, they didn't trust the numbers, and they definitely didn't want to blow up their own bank cleaning up someone else's crazy problems. So they lowballed. Hard. Early headlines floated a token offer that valued Credit Suisse at a fraction of its already battered market cap. Behind the scenes, UBS pushed for government guarantees on tens of billions in potential losses, plus a loss-sharing arrangement, where the state would eat the first big chunk of any future blow-ups. As we go deeper down this rabbit hole, you start to see the irony. The only way to stop panic about one too-big-to-fail bank was to make its main competitor even bigger. Things will just get crazier and crazier when the solution to systemic risk is necessary, more systemic risk. By Sunday evening, the deal was done in principle. A 167-year-old independent bank was effectively erased in a single weekend, signed away at a steep discount under political pressure and legal duct tape. Welcome to the spectacular rise and fall of Credit Suisse, a logo about to vanish into its oldest rival, and a rescue that would spark a whole new fight over who really got saved. The headline number was brutal. UBS was going to buy Credit Suisse for about 3 billion Swiss francs in stock, a fraction of a bank that had once been worth more than 80 billion. A century and a half of brand equity, sold for less than a decent tech unicorn. But this wasn't some clean, free market deal. This was a bank merger with training wheels, airbags, and a government roll cage. The Swiss state and central bank lined up gigantic guarantees, liquidity lines worth up to 200 billion francs, plus a loss-sharing scheme where taxpayers would eat a chunk of future Credit Suisse blow-ups after UBS took the first hit. In plain English, UBS got the business. The state helped ensure the problems. So what really happened here to the people who actually owned and funded this thing? Let's start with shareholders. Credit Suisse equity holders were dragged into a shotgun wedding on terrible terms. Their stock, already beaten down, was converted into UBS shares at a price that basically locked in years of scandal and incompetence in one number. Massive dilution, catastrophic loss of value. However, they weren't wiped out completely. They still ended up with a small bruised stake in the combined giant, like being allowed to keep a bent hubcap after your car explodes. On paper, that's how the hierarchy is supposed to work. Equity is the first loss piece. Bonds are safer. But as we go deeper down this rabbit hole, things will just get crazier and crazier, because the real shock wasn't the equity, it was the AT1s. Credit Suisse had issued about 16 billion francs of additional Tier 1 bonds, those hybrid instruments invented after 2008 to absorb losses in a crisis. In theory, they sit between regular bonds and equity, higher risk, higher yield, but still ahead of shareholders in the pecking order. In theory. When the deal was announced, Swiss regulators pulled a legal lever buried in the fine print and wrote those AT1s down to zero. Every franc gone. While equity somehow survived. For bond investors around the world, this was like watching gravity reverse. Junior creditors vaporized, but shareholders kept a sliver of value. The official justification was all about specific clauses in Swiss AT1 contracts and emergency powers. The market reaction was simpler. What just happened to the rules? AT1 markets from Europe to Asia went into a panic. Prices plunged, yields spiked, and lawyers started sharpening their pencils. Furious investors argued that even if the documents allowed it, the decision violated every expectation about creditor hierarchy that modern banking was built on. This is a story of what happens when you discover your safe, high-yield product is really just a regulatory science experiment, and that's the real lesson. In a crisis, the glossy capital structure, charts from investment bank pitch decks stop mattering, and the dull, footnoted legal terms suddenly decide who loses their money. Central banks talk about confidence, but the small print talks about power. The irony? This wasn't even the first time Credit Suisse's paperwork and promises would come back to haunt people. In the next part, the scandals behind those promises start to look a lot less like bad luck and a lot more like a business model. And that's where the Credit Suisse story suddenly stops being just about one badly run bank. It becomes a question that makes Swiss officials visibly uncomfortable. Did Switzerland just shoot its own golden goose? For a century, the Swiss banking brand was simple, neutral, predictable, quiet. You put your money in Zurich or Geneva, and the whole point was nothing crazy ever happened. However, in March 2023, the government and regulators ripped up bond contracts, overruled shareholders, and forced UBS to swallow Credit Suisse in a single frantic weekend. SAFE started to look very improvisational. International investors noticed. If you're a sovereign wealth fund or a rich family office, you don't just look at returns, you look at rules. Do contracts mean what they say? Will regulators follow a clear playbook or change it at 2 a.m. on a Sunday because the numbers look bad? When $17 billion of supposedly senior AT1 bonds get written to zero while equity holders get something, people start asking, so what really happened here? This is a story of legal certainty suddenly feeling uncertain. The Swiss regulator said the fine print allowed it. Lawyers in London, New York, and Singapore started reading that same fine print like it was a horror novel. If that clause can be used like this once, could it be used again? Or in the next crisis, does safest banking hub just mean safest for whichever bank the state wants to save? Then there's the size problem. By fusing UBS and Credit Suisse, Switzerland didn't just rescue the system, it created a single megabank whose balance sheet now towers over the country's GDP. The classic joke about banks is that some are too big to fail. UBS is now too big to even imagine failing. That concentrates risk in one place, under one management team, in one tiny alpine country that suddenly looks a lot less in control than the brochures suggest. Inside Switzerland, the backlash was immediate. Politicians on the left and right were furious about moral hazard, about a business culture that privatized profits in boom times and socialized the problems when it all blew up. Taxpayers heard the words state guarantees and liquidity backstops and understood exactly who was on the hook if things will just get crazier and crazier next time. Thousands of jobs were at risk, especially in Zurich and Ticino, and people who had nothing to do with exotic derivatives were paying the price. The irony is brutal. The country that built its modern wealth on being the boring, ultra-stable vault of Europe just presided over one of the most dramatic bank rescues since 2008. Welcome to the spectacular rise and fall of Swiss banking as a marketing slogan. And as we go deeper down this rabbit hole, the question gets bigger than Credit Suisse, or even Switzerland. If SAFE can include emergency mergers, torn up contracts, and one bank dominating a whole nation, What does safety in modern finance actually mean? Safety sounded simple, but if you actually opened up Credit Suisse's books, what you saw wasn't a smoking crater of subprime sludge like 2008. It was something messier and in some ways scarier. A huge, complicated balance sheet where a lot of the assets were technically fine, but the story they told about the future was not. So what really happened here? Credit Suisse wasn't sitting on mountains of worthless US mortgages. A big chunk of its assets were high quality, loans to solid corporates, wealthy private banking clients, boring Swiss mortgages that almost never default. So on paper, the bank met capital ratios, passed stress tests, and could still point to rich clients and decent collateral. However, banking isn't just about what you own today. It's about whether those assets actually earn more than the headaches they create. And that's where Credit Suisse kept failing. The risk-adjusted returns were weak. The cost of running the machine, paying for scandals, and constantly fixing old problems ate into almost every Swiss franc of profit. The real landmines were in the shadows of the investment bank. Legacy exposures from the go-go years, structured products, complex derivatives, and positions that had to be wound down or sold at bad prices. Each time they tried to shrink that beast, they booked write-downs, exit costs, and restructuring charges. The balance sheet survived. The income statement bled. Then you had the legal baggage, years of fines and settlements from tax evasion cases, FX rigging, the Mozambique tuna bonds, Greensill, Archegos. Individually, these didn't kill the bank, but they quietly drained capital, one painful disclosure at a time, and they drained something harder to measure: management attention. This is a story of a bank whose executives spent more time putting out fires than building a business. Instead of focusing on clean, repeatable earnings, they were constantly negotiating with regulators, lawyers, and angry counterparties. Every few quarters, another one-off charge, another legacy issue, another promise that the worst was behind them. Things will just get crazier and crazier, right up until the market stops believing that line. By 2023, the real question wasn't, is there a secret toxic asset pool we haven't found yet? It was, why should anyone believe this bank can earn its way out of trouble? Future earnings power looked fragile. The cost of funding was rising because investors demanded a risk premium. Wealthy clients who are very allergic to drama started quietly moving money elsewhere. On a spreadsheet, Credit Suisse could argue it was solvent. But in a confidence game like banking, complicated and questionable can be just as deadly as obviously insolvent. As we go deeper down this rabbit hole, the balance sheet is only half the story. The other half is culture, who got rewarded, who got ignored, and why the same kinds of problems kept coming back. Culture is the software running in the background. And at Credit Suisse, that software kept rewarding the people who broke things. Over and over, the same pattern showed up. If you were a star who brought in money, people deferred to you. If you were in risk or compliance and said, hey, this looks crazy, you were seen as the problem. Fines were treated like parking tickets in a rich neighborhood. Annoying, expensive, but absolutely baked into the business plan. This is a story of a bank that learned the wrong lessons from its own success. Early on, the aggressive bets paid. Risky structured products, edgy emerging market clients, opaque offshore money. When those deals didn't blow up immediately, they created a dangerous confidence. The message wasn't, we got lucky. The message was, see, we know how far we can push it. So what really happened here is basic psychology with a Swiss accent. When you run a risky play and win, your brain quietly upgrades that play from risky to smart. At Credit Suisse, that upgrade happened at the organizational level. The more they got away with, the more people believed that rules were flexible, regulators were negotiable, and management could always manage any problems away with a good lawyer and a settlement. Inside the bank, they didn't say, "We're reckless." They told themselves they were entrepreneurial. They weren't like those boring, stodgy rivals across the river. They were faster, more creative, more willing to do the deals others wouldn't touch. But when your idea of innovation is just adding a few extra layers of complexity to the same old leverage and fee games, the line between creativity and rule bending gets very blurry, very quickly. You can see it in the internal narratives around scandals. Mozambique's hidden tuna bonds? That wasn't framed as corruption. That was framed as frontier finance. Greensill's supply chain funds? That was marketed as clever yield engineering for sophisticated clients. Archegos? Just a misunderstood family office relationship that, unfortunately, happened to vaporize around $5.5 billion. As we go deeper down this rabbit hole, leadership changes start to look almost cosmetic. New CEOs arrived with fresh slogans, reorg charts, and transformational PowerPoints. However, the underlying incentive structure barely moved. The people who made the most money still had the loudest voices. The people paid to say no still learned that saying yes but was better for their careers. By the 2010s, Credit Suisse's culture had drifted a long way from cautious Swiss stewardship. On the outside, it still had the Alps, the discreet private banking brand, the whole neutrality vibe. On the inside, it looked more like a global deal chasing machine that just happened to fly a Swiss flag. And when your machine is tuned for speed, not survival, what happens the first time the road really bends? Because the next phase isn't just about individual scandals. It's about how those cultural choices finally collided with reality, all at once. On the outside, that collision just looked like one bank gone wrong. On the inside, it was a full tour of every modern banking nightmare you can think of. Tax evasion? Credit Suisse literally ran a cross-border business helping rich Americans hide money from the IRS, paying hundreds of millions in fines when that blew up. Sovereign corruption? Bankers pushed over $1 billion of secret tuna bonds onto Mozambique with kickbacks, fake invoices, and a country left drowning in debt. Opaque funds? They wrapped Greensill's supply chain loans into $10 billion of safe products for clients. Concentrated hedge fund exposure? Archegos, where one family office wiped out around $5.5 billion in a weekend. It wasn't one bad bet. It was the full sampler platter. So what really happened here? Was Credit Suisse just cursed with uniquely reckless executives? Or was it simply the unlucky bank where every standard industry temptation actually detonated at the same time? Because if you zoom out, this is a story of a bank that managed to touch almost every risk category on the menu: regulatory arbitrage, off-balance sheet games, star clients treated like royalty until they blew a hole in the hull, wealth products sold as boring income machines that were, in reality, complex chains of credit risk held together with optimism and fees. That sounds extreme. However, parts of it might feel uncomfortably familiar if you've watched big banks for a while. Other global players have paid billions for helping clients dodge taxes. FX desks across multiple banks were caught rigging currency markets. Deutsche Bank, BNP Paribas, JP Morgan, the list of fines for sanctions breaches, bribery, and mis-selling could fill its own prospectus. And those star client blow-ups? Archegos wasn't the first. Think of long-term capital management in the 90s, or more recently, family offices and hedge funds that suddenly revealed just how much leverage they'd been given once the margin calls hit. The names change, but the business idea is weirdly stable. One supposedly brilliant client, multiple banks competing to lend them as much as possible, everyone shocked when gravity shows up. Even the wealth management side isn't unique. Structured notes, yield enhancement products, cash-like funds that somehow pay way above cash. You see versions of Greensill-style promises all over the place. Safe, stable, boring. Until they aren't. So maybe the scary question isn't, how did Credit Suisse become a financial crime scene with a banking license? Maybe the real question is, how much of modern global banking quietly runs on the same cultural software, the same incentives, the same worship of revenue, the same tolerance for gray area deals, that finally broke this one institution? As we go deeper down this rabbit hole, things will just get crazier and crazier. Because in the next part, we're going to zoom out, not just to other banks, but to tech unicorns, consulting empires, and corporate cults that all run the same playbook. Welcome to the spectacular rise and fall of a mindset that might be a lot bigger than Credit Suisse. And if this really is a system problem, not a one-off, then Credit Suisse might not be the last warning shot. So if this isn't just a Credit Suisse problem, what is it? To answer that, you have to talk about something people usually reserve for fringe religions and self-help gurus: cult dynamics. This is a story of organizations that start to look and feel like cults without ever putting that word on a slide. They share the same core traits: a charismatic leader or center of gravity, a grand mission that makes normal business look boring, a hard in-group versus out-group line, and a private language that can turn pretty questionable behavior into something that sounds almost noble. In a typical cult, the charisma is a person. In high finance, the charisma can be a logo, or a passport, or a myth. Credit Suisse didn't have an Adam Neumann walking around barefoot on trading floors, but it had something arguably more powerful: the idea of Swiss safety, elite client access, and this almost mystical belief in sophisticated risk management. The pitch was simple: give us your money, we're the grown-ups in the room. However, inside the building, the energy is very different from the marble lobby. Banks develop their own internal slogans, half jokes and mantras that signal who really belongs. At places like Credit Suisse, you'd hear variations of the same thing. We're smarter, we see around corners, we manage risk better. Regulators and journalists don't fully get what we do. Say that enough times and it stops being a line. It becomes an identity. Here's the pattern interrupt. Most people think of bankers as cold rational calculators, pure numbers and spreadsheets. But the real engine is emotional: status, belonging, the rush of being on the inside. When a young analyst hears senior dealmakers talk about adding value, while structuring something like those Mozambique loans, the message isn't just technical, it's tribal. You're either one of us or you're one of them. Language does a lot of the heavy lifting. A tax dodge becomes optimization. A kickback becomes relationship management. Massive leverage is capital efficiency. Compliance is business prevention. Once that vocabulary sets in, bending the rules doesn't feel like breaking them. It feels like being clever. And if you truly believe your bank is uniquely capable, it's very easy to see regulations as obstacles designed for lesser players who don't understand how the game really works. As we go deeper down this rabbit hole, things will just get crazier and crazier, because this mindset doesn't stay confined to one rogue desk. It seeps into hiring, promotions, bonuses, and who gets called a star. Over time, Credit Suisse built its own mild cult around risk takers and deal makers. Not a single messianic founder, but a rotating cast of leaders all feeding the same myth that the path to being rich, respected, and world-class ran through bigger deals, edgier clients, and smarter ways around the rules. So what really happened here is that by the time the scandals started piling up, the culture already had an answer ready. The problem wasn't us. The problem was them. And in the next section, we'll see what happens when that cult logic collides with reality, losses, and regulators who finally say no. Cult logic colliding with regulators sounds extreme. But this is a story of something we've seen before, just with different hoodies and different suits. Think about the recent Hall of Fame for implosions: WeWork, Theranos, FTX. Each sold a crazy, world-changing idea. Shared offices were suddenly a physical social network. A blood testing machine that barely worked was going to revolutionize healthcare. A Bahamas crypto casino was rebranded as the future of money and democracy. The pitch was always bigger than the business. Inside those companies, the culture followed the pitch. Aggressive growth targets weren't just goals, they were morality tests. You either believed or you were a problem. At WeWork, employees were told they were changing the world by selling desks. At Theranos, questioning the machine meant you didn't get it. At FTX, anyone raising basic risk questions looked like a dinosaur who hated innovation. Get on the bus or get out. Credit Suisse didn't have a barefoot messiah in a conference room. However, it did have a cult. The object of worship just looked more respectable. It was revenue. It was risk. It was the deal. The internal message was simple: hit the numbers. The faster, the better. Star bankers were treated like unicorn founders, except instead of pitching vision on stage, they were pitching leveraged trades and exotic structures in private rooms. If you were the person saying, maybe we shouldn't lend billions into opaque Mozambique fishing projects, you weren't a prudent risk manager. You were the one slowing the machine. In startups, skeptics get labeled not team players. In a bank, they get labeled commercially unhelpful. Different words, same exile. So what really happened here is that Credit Suisse built its own version of the unicorn cult, where the hero wasn't a single visionary, but the collective belief that more risk, more leverage, more fee income would somehow make the problems disappear. And just like with WeWork, Theranos, and FTX, the cult never exists alone. It needs believers on the outside. Venture capital firms kept wiring money to Neumann. Sophisticated investors begged to get into FTX. In Credit Suisse's case, the enablers were pension funds, sovereign wealth funds, hedge funds, rating agencies, and clients who loved the rich yields and clever products and politely ignored the fine print. Analysts rewarded the short-term numbers. Investors cheered cost cuts and revenue spikes. Clients bragged about access to structured solutions that made them feel smarter than the market. Governance risk was invisible, right up until it was the only thing that mattered. As we go deeper down this rabbit hole, the line between a high-performance culture and a full-blown cult starts to look very thin. You push people hard, you pay them a lot of money, you tell them they're special, and you wrap it all in a story about winning at all costs. At some point, are you building excellence or are you building denial? Because if a 167-year-old Swiss bank can end up running the same basic playbook as a failed co-working startup and a collapsed crypto exchange, then things will just get crazier and crazier when we look at what happened once the losses finally hit the surface. Regulators had the rulebook. Credit Suisse had the workaround. Most financial regulation is built for balance sheets, not belief systems. You can measure capital ratios, liquidity buffers, large exposures. You can write a neat little rule that says Don't finance secret Mozambican tuna bonds with hidden fees and bribes, but you can't easily outlaw a business culture that treats every rule as a puzzle, every limit as an invitation to get creative. So what really happened here is that the regulators were mostly looking at numbers, while Credit Suisse was running on vibes. On paper, the bank could tick the boxes: minimum capital met, liquidity okay, risk models signed off. Even after Greensill and Archegos, the spreadsheets could be made to look acceptable. Inside the bank, however, the softer stuff was going wild. Star dealmakers were worshipped, internal critics sidelined, and the heroes were the people who found ways around the guardrails, not the ones who actually fixed the problems. This is a story of compliance as theater. You run training, you send emails, you add a new committee. Then you hand the real power to a handful of rainmakers who bring in big money and tell them they're special. If those people see rules as something to be managed, the entire tone of the institution shifts. Credit Suisse could technically comply with a lot of regulations while still rewarding the exact behavior those regulations were trying to stop. For regulators, that creates a crazy kind of trap. It's hard enough to prove one bad trade or one corrupt banker in court. Proving that an entire culture was systematically encouraging rule bending, that's another level. Intent lives in jokes on trading floors, in who gets promoted, in which risk officer quietly learns to stop asking questions. None of that shows up in a neat PDF you can attach to an enforcement action, so you get the pattern we saw here. Investigate, negotiate, fine, move on. Billions in penalties for tax evasion, for structured products, for Mozambique. Public scolding, private promises, a new transformation plan. But fines hit shareholders, not the internal cult of personality and profit. The people who drove the behavior often kept their jobs, or at least their reputations. As we go deeper down this rabbit hole, you start to see why regulators are experimenting with new tools. Culture audits that dig into incentives and behavior, not just policies. Senior manager accountability regimes where specific executives are on the hook if their area blows up. More intrusive supervision of bonus structures, clawbacks, and who actually gets rich when a risky business line takes off. The uncomfortable question is whether, in Credit Suisse's case, that shift came way too late. Should regulators have moved earlier from fine and monitor to force radical change or breakup? And if a 167-year-old Swiss bank can slide all the way into a shotgun merger before anyone pulls that trigger, what does that say about the next global bank playing the same game right now? Regulators finally pulled the trigger. But the rescue came with a catch. To save the system, they had to create an even bigger monster inside it. Over a single weekend, UBS went from rival to acquirer, suddenly responsible for swallowing a bank that, on paper, wasn't much smaller than itself. This is a story of forced corporate cannibalism. UBS's job wasn't just to buy Credit Suisse. It had to cherry-pick the good stuff, the rich clients, the profitable wealth management franchises, the still decent Swiss domestic business, and quietly shove the toxic leftovers into the financial equivalent of a biohazard bag. On Monday morning, the integration reality hit. Two global banks meant overlapping branches on the same Zurich streets, duplicate trading floors, and armies of back-office staff doing the same work on totally different systems. IT alone was a nightmare. Decades of Credit Suisse legacy software had to be mapped, merged, or killed, all while traders and bankers were supposed to keep doing deals like nothing crazy had just happened. And then there were the clients. Credit Suisse's wealth customers had just watched their safe, Swiss bank, almost vanish in real time. UBS had to move fast, calling top families and hedge funds, flying private bankers around, basically saying, "Your money is fine. Your relationship manager is staying. Please don't run." The irony was brutal. The same people who fled because Credit Suisse looked risky were now being told to relax under an even bigger, more complex balance sheet. Regulators had their own problems. To stop one crisis, they had created a single Swiss banking superpower. Domestically, UBS now dominates everything from mortgages to small business lending. Globally, it's even more too big to fail than before, exactly the scenario post-2008 reforms were supposed to avoid. So what really happened here? Did they solve risk, or just concentrate it in one place and hope the risk culture behaves this time? UBS tried to answer that by taking a chainsaw to the worst parts. Early on, it moved to shut down most of Credit Suisse's investment bank, killing the dream of a standalone Wall Street player and folding only a few niche units into its own operations. The Credit Suisse brand started disappearing from buildings, websites, even email signatures, replaced with UBS logos and carefully crafted talking points about heritage and continuity, while lawyers quietly tried to ring-fence legacy legal cases from Mozambique to Archegos. Officially, Credit Suisse is gone. No ticker, no standalone headquarters, no independent board. But as we go deeper down this rabbit hole, you start to see its ghost everywhere inside UBS. The bankers, the clients, the risk models, even fragments of that old growth at all costs mentality. The name died in a weekend. The culture? That's where things will just get crazier and crazier. The name died in a weekend. The people who worked under that name did not. Inside Credit Suisse, the end didn't feel like a clean merger. It felt like a slow evacuation from a burning building where the fire started on an executive floor you never had access to. A mid-level risk analyst in Zurich, a branch manager in Geneva, a junior trader in London, most had nothing to do with Mozambique tuna bonds, Greensill, or Archegos. However, their careers became collateral for scandals they only ever read about in internal memos. One day, you're selling stable Swiss banking as a lifelong career path. The next, HR is on a video call explaining synergies with UBS. That word sounds rich, but for thousands it translated into, your desk is gone, your bonus is gone, your visa is in question, please hand back the laptop. This is a story of how a bank can survive world wars and still manage to blow up the lives of people who never signed off on a single crazy deal. Clients felt it too. Imagine a family business in Basel that had banked with Credit Suisse for 3 generations. Their relationship manager knew the kids' names, the succession plans, the quiet divorces. Overnight, that relationship turned into a PDF explaining new UBS account numbers and a helpline. The money was technically safe, guaranteed by the state and the new megabank. But the trust, that's harder to ensure. How do you rebuild confidence when the brand that sold discretion and safety ends up needing an emergency rescue on a Sunday night? Even the ultra-rich weren't thrilled. A billionaire who once bragged at dinner about his Swiss Fortress custody account now had to explain why his fortress needed a taxpayer-backed bailout. The irony writes itself, but the awkward phone calls did not. Then there were the people who never set foot in a marble lobby. Local Swiss communities had Credit Suisse logos on hockey jerseys, music festivals, university programs. Suppliers, from IT contractors in India to caterers in Zurich, had built their entire business around this one massive client. When the shotgun wedding with UBS happened, purchase orders froze, projects were reassessed, and the message was clear. If you were orbiting the old Credit Suisse sun, you might want to find a new galaxy. And in the background, pension funds and ordinary investors were watching their statements. Teachers in Europe, municipal workers in the US, small savers in Switzerland held Credit Suisse shares, or those infamous AT1 bonds. Many never fully understood the bank's risk profile. They just saw big old Swiss. Then, in March 2023, regulators wrote down 16 billion francs of AT1s to zero, while still paying something to shareholders. If you were a retiree holding those bonds because your advisor said they were pretty safe income, that was a brutal way to learn how bank capital structures actually work. So what really happened here is that a culture of reckless risk didn't just nuke quarterly earnings, it radiated out into normal lives. As we go deeper down this rabbit hole, you start to see that the real cost of too big to fail isn't paid in press releases. It's paid by people who never sat in the rooms where the bad ideas were approved. And the next part of the story is who actually did sit in those rooms and how they walked away. So imagine this is not a documentary about some Swiss bank with a Latin name. Imagine it's a Sunday night, you're scrolling your phone in sweatpants, and a push alert pops up. Your bank is being rescued in an emergency deal before markets open. No time to vote, no time to complain. Just, it's gone. How safe would your money feel then? Because that is the crazy part about Credit Suisse. For most of its 167 years, it was the boring answer, the safe answer, the place that financed railways, not reality shows. However, when the culture rotted, the collapse didn't just hit hedge funds and rich family offices. It hit regular people who woke up asking, wait, if a Swiss giant can blow up over a weekend, what does that say about my bank? This is a story of unique scandals sitting on top of very common pressures. Credit Suisse had its own greatest hits album, Mozambique tuna bonds, Greensill, Archegos, corporate espionage that felt like a bad spy movie. But underneath all that, the incentives were painfully familiar. Chase yield in a low-rate world. Reward the rainmakers who bring in the most money this quarter. Underinvest in the boring risk team who keep saying no. Tell a big growth story to investors and hope the problems stay hidden long enough for your stock options to vest. So what really happened here is not just a Swiss tragedy, it's a template. The logos change, the scandals get new names, but the idea is the same. When short-term performance becomes the only god, risk culture becomes a costume. The bank still talks about prudence and trust in glossy ads, while inside, people learn that the real promotion criteria is, did you hit your number? And here's the uncomfortable bit. How much do you actually know about your own bank's risk culture compared to its marketing? You probably know the color of their app icon, their cashback offers, maybe the charity they sponsor at halftime. But do you know how often they've been fined? How they pay their executives? Whether the chief risk officer lasts longer than a season of your favorite show? There are simple signals that something might be off. Chronic scandals that keep repeating with slightly different actors. CEOs and chairs spinning through a revolving door every couple of years. Aggressive product pushes that feel a little too magic. Guaranteed returns. Complex yield products being sold to people who just wanted a savings account. When a bank starts to sound like a get-rich-quick business, that's usually when things will just get crazier and crazier. Because if a 167-year-old Swiss institution, wrapped in neutrality and mountains and chocolate, can implode from cultural rot, nobody gets to say, it could never happen here. The real question is, what do you do with that information if you're a customer, an employee, or an investor? As we go deeper down this rabbit hole, the final piece of the story is the part that actually matters for your life. The lessons you can steal before your own push alert shows up. So here's the uncomfortable part. Credit Suisse isn't just a banking horror movie, it's a management case study with your name on it. If a 167-year-old Swiss institution can quietly rot from the inside until it needs a shotgun wedding, what exactly do you think can happen to a 10-year-old startup with a Slack channel and a vibes-based culture deck? This is a story of culture as a control system. Not a slogan, not a mural, not the values page you copy-pasted from another deck. At Credit Suisse, the real culture said, if you bring in money, you are a genius. If you raise risk concerns, you are a problem. Star dealmakers on things like Mozambique's tuna bonds were lionized, even as internal risk teams waved red flags about opaque structures and obvious corruption. Guess which group got promoted? When you celebrate rule-bending rainmakers and sideline the boring people asking annoying questions, you're rewriting the company's operating system. You can hire an army of compliance officers and force everyone through glossy training videos. But if the heroes are the ones who get it done by gaming the rules, the message is clear. The policy manual is theater. The culture is the real law. So what really happened here from a leadership point of view? Incentives. Over and over, Credit Suisse paid for raw revenue and short-term profit. Bankers booked fat fees today and handed the risk to some future quarter, some future executive, some future crisis. That's how you end up all in on clients like Archegos and Greensill, collecting fees on concentrated, fragile bets that explode the moment markets move. If you're a founder or an executive, this is where you steal the playbook in reverse. Defer more compensation, tie bonuses to risk-adjusted returns and multi-year outcomes, not just this year's revenue trophy. Make clawbacks real, not theoretical, so if a deal blows up 3 years later, the people who pushed it don't walk away rich while everyone else cleans up the mess. However, incentives only work if the referees are allowed on the field. At Credit Suisse, risk and compliance technically existed, but they were often outgunned, under-resourced, or parked deep in the hierarchy. If your chief risk officer can be leaned on by a business head, you don't have independent oversight. You have office politics with better spreadsheets. For leaders, that means brutally simple architecture, independent reporting lines to the board, direct access for risk and compliance to challenge deals, and a board that actually backs them when they say no. If the risk team is known as the Department of Business Prevention, you've already lost. They should be the people who keep the business alive long enough to enjoy its own success. And then there's the board itself. Credit Suisse didn't die from one giant scandal. It died from treating a decade of medium-sized scandals as PR headaches instead of existential warnings. Tax evasion cases, FX rigging, Mozambique, espionage, Greensill, Archegos. Each one was a flare in the night sky saying, "Your system is broken." The response was usually, "Let's settle, issue a statement, and move on." If you sit on a board and see the same type of problem repeat with new characters, you are looking at culture, not coincidence. That is the moment to demand deep dives into root causes, to change how pay works, to replace leaders who are clearly addicted to short-term wins. If you don't, you're not unlucky when the collapse comes. You're complicit. As we go deeper down this rabbit hole, Credit Suisse becomes a warning label for every ambitious company. When governance treats culture as branding instead of a system to design, test, and enforce, things will just get crazier and crazier until one weekend the music stops. The next part of the story is what that weekend actually looks like when a global bank flatlines in real time. That weekend when the music stops doesn't come out of nowhere. Inside the building, people have usually been hearing the off-key notes for years. The crazy part is how often they convince themselves it's fine, it's temporary, it's just how big business works. So what really happened here for the rank and file? This is a story of thousands of smart, mostly ethical employees who watched the red flags pile up, one meeting, one memo, one don't make a fuss conversation at a time. If you work in finance or anywhere money and pressure collide, Credit Suisse is less a freak accident and more a mirror. Start with the day-to-day culture tells. When a manager rolls their eyes at compliance and calls it box ticking, that's not a personality quirk, that's a systems alert. When a star producer brags in the kitchen about creative workarounds, about how they get deals done because they know which rules are flexible, you're not hearing hustle, you're hearing future front-page problems. And when people who raise concerns mysteriously stop getting staffed or are reorganized out of the way, you're watching the organization teach everyone else to shut up. At Credit Suisse, versions of that played out around tax evasion clients, around Mozambique's tuna bonds, around Greensill and Archegos. The pattern wasn't subtle, however, the incentives were louder. The people who greased the edges got rich. The people who asked awkward questions got labeled difficult. You only need to see that movie 2 or 3 times before you know how it ends. Another huge tell is how bad news travels. In a healthy shop, problems get surfaced early, fought over, and fixed. It's messy, but public, at least internally. In a sick shop, bad news gets massaged, delayed, and buried until it explodes. Ask yourself, when something breaks, do leaders talk about root causes or about optics? Are they fixing the leak or just repainting the ceiling before the client visit? Because staying in that environment is not a neutral choice. Even if you are clean, the brand sticks to you. When recruiters see chronically scandal-prone bank on your CV, they don't know you were the one honest person in the room. They just see risk. Some Credit Suisse alumni will spend years explaining in every interview that they weren't on the Mozambique deal. They weren't near Archegos. They were in a different division. That's career drag you never see in your bonus statement. So what do you actually do if you spot this pattern? Document what you see. Use internal channels while they still exist. Quietly get external advice if you think you're being pushed into something illegal. And most important, have a personal line you will not cross for a promotion, for a client, for that rich year-end number. If you don't define that line in advance, the culture will happily define it for you. As we go deeper down this rabbit hole, remember, Credit Suisse didn't just reward the wrong behaviors, it trapped good people inside a machine that made those behaviors feel normal. The real question is what happens when that machine finally slams into the wall, and who gets hit first when it does. When that machine hits the wall, it's not the executives who get crushed first. It's the people who thought a famous logo meant their money was safe. Most viewers will never read a 300-page risk report. Honestly, most executives don't want to read it either. However, you don't need a PhD in finance to spot patterns. If a bank keeps popping up in stories about tax evasion, FX rigging, or tuna bonds that somehow involve bribes and missing cash, that's not bad luck. That's a business model leaking through the PR. Credit Suisse paid out billions in fines over a decade. Different scandals, different geographies, same characters, weak controls, aggressive sales, and leadership pretending to be shocked every single time. So what really happened here is simple. When fines become a recurring line item instead of a career-ending event, you're looking at a culture where risk is an afterthought. The second thing is boring but crucial. Do not keep everything in one place. Not deposits, not investments, not your company's main accounts. The rich families who quietly moved part of their money away from Credit Suisse years before the final crisis weren't psychic. They just treated diversification like seatbelts, slightly annoying until the moment you really need them. This is a story of resisting the prestige trap. A 167-year-old Swiss bank with marble lobbies feels safer than a no-name online bank. But risk doesn't care how nice the reception desk looks. If one institution holds your savings, your mortgage, your brokerage account, and your business credit line, you're not a client. You're a hostage. Then there's the stress test you can actually watch in real time. When bad news hits, does the bank come out quickly with clear numbers or vague "we remain strong" statements and no detail? Do they cut bonuses, shrink the balance sheet, and accept short-term pain? Or do they keep insisting nothing is wrong while quietly begging regulators for help? Credit Suisse kept saying it was well capitalized, while deposits were sprinting for the exits. The words were calm. The money was not. Ratings agencies and analyst report should have been another line of defense. On paper, Credit Suisse was still an investment-grade institution, even as it bled trust. However, ratings are like rear-view mirrors. They tell you where the car has been, not that it's currently skidding on ice. As we go deeper down this rabbit hole, remember, you're not just a spectator. When enough people move their accounts, cancel mandates, or refuse to roll over funding, that's market discipline. You are part of the punishment mechanism for banks that treat ethics as a marketing slide. Because if customers keep rewarding bad behavior with more business, things will just get crazier and crazier in the next crisis. Credit Suisse wasn't just a bad apple. It was a reminder that the whole orchard is planted on a fault line. For most of its 167 years, nothing crazy seemed to happen. The bank helped build Swiss railways, financed factories, grew with the country. Long, boring stability. Safe, respectable, almost dull. However, that's exactly where the pattern starts. Long, calm stretches lull everyone into thinking the system is basically safe, so the real game becomes, how do you squeeze out a little bit more? So this is a story of what happens when stability quietly turns into complacency. In the 1990s and 2000s, cheap money flooded the world. Central banks cut rates, investors chased yield, and every big bank was hunting for the next clever trade, the next rich client, the next complex product. Innovation started sprinting. Risk controls jogged behind. At places like Credit Suisse, the line between smart risk-taking and are we insane got very blurry, very fast. Look at Mozambique's tuna bonds. On paper, it was creative infrastructure finance. In reality, it was a $1 billion cocktail of hidden debt, kickbacks, and broken rules. Or Greensill. Supply chain finance sounded like a neat, low-risk idea. It ended with $10 billion of frozen funds and clients wondering how a safe product had turned into a trap. The business kept finding ways to dress up old risks in new packaging because the market kept paying for the costume. Cheap capital makes bad ideas look smart. When money is almost free and everyone else is posting double-digit returns, saying no feels like career suicide. So banks edge closer to the cliff. A little more leverage, a slightly looser covenant, one exception for that star client, then another. By the time Archigos blew a $5.5 billion hole in Credit Suisse's balance sheet, the crazy part wasn't the loss. The crazy part was how many internal warnings had already been ignored. And here's the really uncomfortable bit. We've seen this movie before. 1980s savings and loans. 1990s Asian crisis, 2008 subprime. Every time, the generation that lived through the pain becomes cautious. They build rules. They strengthen compliance. They give speeches about lessons learned. But as we go deeper down this rabbit hole, those lessons have an expiry date. People retire. New executives arrive, armed with backtests, spreadsheets, and the oldest phrase on Wall Street, this time is different. Post-2008, regulators did load the system with safeguards. Higher capital ratios, stress tests, resolution plans. On paper, Credit Suisse passed a lot of them. However, culture and incentives quietly hacked around the guardrails. When bonuses depend on revenue, not on what happens 3 years later, you're basically paying people to outrun the risk department. And for a long time, they did. So what really happened here? Credit Suisse didn't die because of one rogue trader or one unlucky scandal. It died because, in a system built on cheap capital, intense competition, and fading memory, a certain kind of behavior stops looking like misconduct and starts looking like how the game is played. Welcome to the spectacular rise and fall of a bank that survived world wars and depressions, but couldn't survive its own incentives. In the final section, we'll pull the camera all the way back and ask the harder question. If a giant like this can implode in a weekend, what does that say about the financial world the rest of us have to live in? A 167-year-old bank died in a single weekend, but the real death took a decade. Because when you rewind the tape, this isn't the story of one crazy blow-up. This is a story of a bank that slowly trained itself to believe that every scandal was just a PR problem, every fine was just a cost of doing business, and every red flag was someone else's job. So what really happened here? Start with the tax evasion era. For years, Credit Suisse helped rich clients hide money offshore until US authorities came knocking with criminal charges and billion-dollar penalties. Painful, yes. Existential, no. The bank wrote a check, apologized, and carried on. The lesson inside the building wasn't never again. It was closer to we survived, keep going. Then came Mozambique. Bankers arranged over $1 billion of secret loans for tuna fishing and maritime security that magically turned into kickbacks and hidden debt. The deals blew up, the country plunged into crisis, and Credit Suisse paid hundreds of millions to settle. However, inside the bank, the message was still, bad apples, isolated incident, back to work. Spying on former executives in Zurich should have been a stop sign. It looked less like a sober Swiss institution and more like a paranoid soap opera. Senior leaders were fired, reputations shredded, but the board's real takeaway was again, clean it up, move on. Things will just get crazier and crazier from here. Greensill and Archegos finally showed how deep the rot went. With Greensill, Credit Suisse turned $10 billion of supply chain funds into a black box of risky loans dressed up as ultra-safe. With Archegos, it let a single client rack up massive leveraged bets until a 5.5x billion dollar hole appeared overnight. Risk Report had warned about both. People just didn't want to hear it. Meanwhile, the top floor was a revolving door. CEOs in, CEOs out, strategy slides changing faster than the logo. Clients noticed. They started pulling money quietly at first, then loudly. By early 2023, after yet another set of ugly earnings and a badly timed comment from a major investor, confidence snapped. In a business built on trust, that's the equivalent of the floor disappearing. Credit Suisse wasn't killed by one bad trade. It was killed by a culture that treated scandals as speed bumps instead of stop signs, that believed the narrative of being a world-class bank, even as the numbers were being generated by increasingly desperate ideas. And that's the core lesson. In banking, balance sheets matter, but the story and the culture behind those numbers matter just as much, because they determine what risks people take, what they hide, and what they tell themselves is still normal. As we go deeper down this rabbit hole, the uncomfortable question becomes, if a giant this old and prestigious can rot from within, how do you build vigilance into the way we reward, regulate, and relate to financial power before the next quiet weekend turns into another historic funeral? So now it's your turn to perform the autopsy. We've seen the scandals, the quiet weekends, the very public funeral. But if you had to pick one moment where Credit Suisse stopped being a bank and became a countdown timer, where do you put the pin? Was it Mozambique, when a 19th century infrastructure lender helped sell over $1 billion of tuna bonds that secretly funded kickbacks and weapons, and then tried to pretend it was all just a misunderstanding in the fine print? Was that the point where the business stopped being about financing railways and started being about financing excuses? Or was it Greensill when they wrapped $10 billion of supply chain paper in the Credit Suisse logo like it was some kind of safety seal, and clients only discovered how risky it really was when the whole thing froze? Maybe for you, the real death blow was Archegos, a single-family office that somehow cost a supposedly sophisticated global bank around $5.5 to $6 billion, because no one wanted to be the boring person in the room who said stop. Maybe it goes even earlier. Maybe the spying scandal is your line in the sand. The moment a Swiss bank, famous for discretion, was caught literally tailing its own former executives through Zurich streets like a budget spy movie. Or maybe you think those were just symptoms, and the real break happened decades before, when the culture slowly shifted from cautious Swiss conservatism to star banker worship, leverage, and the idea that rules were something you managed, not something you followed. So what really happened here in your view? In the comments, say whether you see Credit Suisse as a one-off failure, a uniquely messy story of bad luck and bad people, or as a warning sign that the entire global banking system has deeper cultural problems baked into it. Is this just one rotten apple, or is the orchard quietly sick? And if you actually work in this world, this is where it gets interesting. If you're in finance, law, compliance, regulation, risk, even if you're watching this on mute at your desk right now, add your perspective. You can keep it vague, anonymized, change names, change countries. But how real do these cultural dynamics feel where you are? The pressure to chase fees, the unspoken rules, the way people talk when they think the microphones are off. This is a story of power, money, and people convincing themselves they're still the good guys. As we go deeper down this rabbit hole, things will just get crazier and crazier. So tell us which cult-like corporate stories you want broken down next in this narrative, investigative style. Another bank? A hedge fund? A startup that swears it's changing the world, but mostly seems to be changing its investors into less rich people? Leave your theory, your insider detail, and your next target below, because the next chapter in this series might start with your comment. If you're still here at the end of a 167-year-old bank's slow-motion car crash, you're exactly the kind of person this channel is built for. This is a story of money, power, and institutions that start to look a lot like corporate cults when you strip away the branding. From scrappy startups with one crazy idea and a pitch deck, to century-old banks that once financed railways and end up financing bribes, the mission here is simple. Go past the press release, past the PR spin, and into the mechanics of how supposedly serious businesses go completely off the rails. So if you actually enjoy unpacking complex financial dramas, instead of just scrolling past the headline, hit subscribe, turn on notifications, join the small but growing group of people who think reading a risk report is a fun Friday night, and who want every too big to fail story translated into something you can tell your friends at dinner without them falling asleep. As we go deeper down this rabbit hole, things will just get crazier and crazier. Credit Suisse was a global bank that survived world wars, inflation, and entire monetary regimes changing, but it could not survive its own executives and their problems. Coming up, we're looking at other banks that are still standing on paper, but already wobbling in reality. Tech unicorns that went from world-changing to, wait, this was just an unprofitable spreadsheet all along, and smaller scandals that never made front-page news, but make this Credit Suisse saga look almost polite. We're talking mid-tier lenders that quietly turned into leverage machines, fintechs that dressed up old payday loan math as innovation, and private companies raising billions on vibes while their internal controls exist mostly in motivational slide decks. Some of these episodes will be about names you recognize. Some will be about places no one is watching yet, where the real damage usually starts. If you know someone who still believes big banks are automatically safe because they're old, regulated, and have marble lobbies, send them this video. A colleague who thinks Swiss is a personality type and a risk rating. A manager who says our compliance team would never let that happen. Let Credit Suisse handle that conversation for you. So what really happened here is not just that one bank died, it's that a 167-year-old Swiss institution with every possible advantage showed how fragile the whole idea of safety can be when culture rots. If a bank that helped build modern Switzerland can turn into a financial crime scene with a logo, imagine what's happening in places no one's looking at yet. Subscribe, stay in this rabbit hole, and we'll keep looking.